Welcome to Taking Stock for the week ending the 22nd of April 2022. We're joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome to you, Matt.
Thank you, Kien, and thanks for having me.
But before we get started, we need to let you know that the information provided today is of a general nature and therefore should not be considered personal advice. Any tables and charts presented is based on historical data and therefore should not be relied upon as a guide for future performance. And now to the markets. Just when it was looking like a mild week for the markets, the Federal Reserve Chairman, Jerome Powell, made comments at an IMF function in Washington overnight that rattled settlement quite a bit.
Yeah, it certainly did, Kien, and Powell once again made it very clear that the Fed are serious about fighting inflation and indicated that as much as a 50 basis point rise was on the table for their meeting in May. So markets have been pricing in a number of rate rises already this year. So we're not necessarily concerned or surprised by these comments, but as we're all discussing and have been discussing for much of the year, rate rises and inflation are going to keep things volatile for the foreseeable future. And every time we see this volatility spike at small caps and growth stocks, the segment of the market that seem to get hit the hardest. But that's just markets behaving in a fairly predictable way. What we're concerned with is how the supply chain disruptions and inflation are impacting companies and earnings at a fundamental level. And the US reporting period is providing some level of insight there, isn't it, Kien?
That's right, Matt. The US first quarter earnings season has been off to a solid start with roughly around 80% of companies beating profit estimates to date. This compares to the long-term average of around 66%. So despite the fact that inflation figures are at multi-decade highs and have been elevated for over 6 months, we haven't really seen the impact to margins and profitabilities that dramatically. In fact, earnings growth forecast, as indicated by the black line on the screen, continues to rise irrespective of the volatility across the market, and that's shown by the blue line.
Yeah, Ken, it's been an impressive start to reporting period once again, but sentiment was, well, particularly amongst growth stock, was somewhat tempered by the Netflix result on Wednesday, as many of you would have observed in the financial media. Now, although the financial result was actually ahead of expectations, the story that had investors in somewhat of a tailspin was the fall in its most significant or most important metric, which is net subscriber growth. For the first time in over a decade, the company lost 200,000 subscribers, which was well below their own guidance that they provided in their last result, which was for growth of about 2.5 million. Now, part of the reason for the net drop in subscribers was the company's decision to cut off Russia from their streaming service. So ex-Russia, there was about 500,000 net additions. So not as bad, but still a significant slowdown in growth. And to add, the company guided for a net loss of 2 million subscribers in the next quarter, which is significant. And that's why the reason the share price tanked some 35% after the announcement. Now, pleasingly, the US Growth Fund doesn't own a position in Netflix because of its high levels of debt and weak net cash flow generation. So the stock actually fails our financial health score. But the announcement did reverberate through the growth end of global markets, including some of our own holdings, which went down in sympathy. We're confident that Netflix isn't really much of a bellwether for growth or tech stocks. They're not really a technology company at the end of the day, are they, Ken? They're more of a media company or a content provider. So the predominant reasons for the slowdown are more related to fierce competition in streaming platforms and a current lack of engaging content. The real bellwethers for the tech sector are obviously the heavyweights, Apple and Google. Both of those stocks are in our US portfolio, and they're going to be reporting their quarterly earnings next week, along with stocks like Microsoft. So we think the sentiment tone will be set next week on how these large businesses report and guide to the market.
Yeah, and further volatility across our growth and small cap stocks as a result of these overseas events could present opportunities here in Australia as well. Right now, we are going through the AGM season with many Australian companies reconfirming earnings guidance. In fact, the trend in corporate earnings have continued to rise strongly over the last month, and that's driven predominantly by the resources sector, and that's on the back of analyst upgrades to elevated commodity prices. And this can be shown on Stock Doctor with the diversified miner BHP, where its earnings have been revised higher by about 12% over the last 3 months.
Yeah, and interesting, the earnings revisions to this point have remained strong, despite the company downgrading its copper and nickel production volumes by 5% due to pandemic-related labour shortages. However, the production for its flagship iron ore and coal segment is on track to meet its full-year guidance. And with commodity prices as strong as they are, we expect free cash flow and gross dividend yield to be over 13% for the year.
Yeah, similarly, despite reporting an 8% decline in iron ore shipments for the quarter compared to last year, Rio Tinto experienced a 27% upward revision to its earnings expectations over the last 3 months. What this tells us is that investors shouldn't worry too much about the modest production setbacks in an environment where commodity prices remain strong. Rio currently is on a forward gross dividend yield of over 14%, and is also supported by solid cash flow generation.
Another borderline star growth stock to provide an update this week was supply chain logistics operator Brambles. The company upgraded its earnings growth guidance to 6 to 7% from its previous position of 3 to 5%. So this should lead to some positive earnings revisions over the next few days. Now, interestingly, with this one, you'd think that Brambles should face significant margin pressure from rising timber costs used for its pallets, but the company has been able to lift its prices and improve the efficiency of its operations, allowing it to maintain its margins.
Yeah, that's what happens with these high quality companies. But another star growth stock that has been under pressure in more recent times is Netwealth. Last week, the company revealed that its fund inflows has been tracking below consensus expectations, even though it was in line with management guidance. Currently, consensus is anticipating fund inflows of 14 billion compared to management guidance of around 13.5 billion for this year. Hence, we have begun to see earnings forecasts being revised down. But you might be wondering why the market consensus is being overly optimistic with its earnings projections, especially with earnings growth for this year expected to be in the low single digits. And the reason for this is because since the start of financial year 22, management have issued a few upgrades to their financial year 22 fund inflow guidance, initially starting at 10 billion in August 2021 to exceeding 13.5 billion in February 2022. Also, Netwealth has a track record of exceeding its own guidance in the past.
Yeah, that it does. But share price sentiment on the stock has been weak on the back of the slowdown in earnings growth and the rotation away from growth stocks with which do trade on fairly elevated PE multiples. Now, the trade-sensitive investors should remain out of this stock because it has breached SD30 TSR and is trading in a bearish trend on the SD Max indicator. However, those who believe in the strong fundamentals of the business could view the share price weakness as obviously an opportunity. Given that the business earns income from its clients' cash balances, the company is going to be a beneficiary of this rising interest rate environment.
Yeah, that's a good point, Matt. But also on more positive news as well, medical imaging company and star growth stock Medicus announced another contract win in North America worth around 32 million spread over a period of about 8 years with a group called Innova Health Systems. The deal represents an annual revenue increase of around 4 million or approximately about 5% to its revenue. And despite this, many investors may be concerned that the stock is trading on a forward PE multiple of over 100 times, while short interest under Golden Rule 4 is rising as well.
We love this stock, Kien, in the fund team. And look, I think it's important to remind investors that PE multiples are not particularly useful gauge of companies that are, they haven't nearly peaked in terms of their expansion phase. We like this business because they've got net cash flow on the balance sheet and their imaging software product Visage is market leading in the imaging space, and their continual growth in clients and growth in market share is testament to this fact. Now, the short interest in the stock seems high at 5%, but we've been in this territory before, and the funds that have held short positions in this stock have very rarely been successful. So we're going to continue to remain long in the fund, that's for sure.
Yeah, meanwhile, earnings growth is expected to remain strong over the next few years as well. And we are also pleased to see the CEO, Sam Hupert, continue to hold a significant stake at around 26%. Now, moving forward, looking at our corporate calendar for the week ahead, no companies are expected to report and no star income stocks are going ex-dividend. However, we do have some March quarterly updates from Woodside Petroleum, Northern Star, IGO, South32 and Beach Energy. Also, Coles, ResMed and Genworth are also expected to provide business updates as well. And moving on to our technical indicators, there have been bullish SD Max trend changes from Lynas Rare Earths, Macquarie Group, and Cogstate. The SD Max is the stock doctor moving average crossover, ideal for the highly trend sensitive investor. Meanwhile, for those who are moderately trend sensitive, we have APA Group. They've signalled a re-entry on the SD30 TSR, which is the stock doctor 30% loss from its highs or gains from its lows. This week, for Under the Microscope, we take a look at DDH1, a mineral drilling contractor with exposure to gold at around 48%, iron ore at around 19%, and the remainder in nickel and copper. You might be wondering though, why it's classified under the resources model. And the reason for this is because its business lies in mining and extracting metals and minerals, even though it doesn't have the exposure to the operational risks of a miner.
And earnings growth is pleasingly expected to accelerate in financial year 23 as their recent acquisition of WA-based contracting company Swick contributes to its earnings, and it will also benefit from the expected uplift in exploration spending amongst the miners. So Swick is Australia's largest underground driller with operations in the US and Europe, and adds 72 drill rigs to its fleet, taking the total rig count to about 176. And there appears to be decent visibility in the outlook, with 4 analysts providing consensus estimates.
And although it's tied to resources, DDH1 is also a star income stock because its earnings should be less volatile than your traditional resources stock, because the source of its revenue, drilling, occurs at all stages of a mine life rather in response to commodity price movements. The company should continue to generate excess free cash flow above dividend expectations, and with drilling activity expected to remain strong due to elevated commodity prices, we believe the gross dividend yield of over 6% is sustainable.
And the company was established in 2006, and positively, the founders remain fairly involved. Murray Pollack, for example, is a non-executive director and currently holds still 11% of the business, while CEO Cy Van Dyke owns a modest amount of 1.2% of the business.
And on Stock Doctor, with the stock trading at a discount to valuation and having a reasonable amount of liquidity at around 500k average daily trade for retail investors, we believe this could be an attractive small cap opportunity for investors. Woodside Petroleum is preparing for its merger with BHP's petroleum business, following at least a 50% approval from Woodside shareholders, and plans to list its shares on the London and New York Stock Exchange as well. So the question this week is, how will this transaction, if approved, impact the shareholders?
Very good question, Kien, and we're getting plenty of questions from our subscriber base. So on completion of the deal, BHP shareholders will hold about 48% of the new combined Woodside Petroleum company. So there is a risk that the share price of Woodside Petroleum could come under some short-term pressure, and that depends on how many of the BHP shareholders sell out of the Woodside stock that they'll receive as part of this deal. Now, BHP has a substantial overseas register, as we know. They're a global company, and in certain areas of the world in which they're currently listed, like South Africa, there'll be investors that are eligible to hold the distributed shares. This is the major part of the reason why Woodside have decided to go with its secondary listings in London and New York, to accommodate for those investors in those particular jurisdictions, and hoping that those institutional funds will hold on to their new Woodside shares.
Yeah, and at the business level for Woodside shareholders, the deal is expected to yield about 400 million a year in synergies, and also reduce its debt. That means improve its financial health. It will also provide near-term cash flows to fund the Scarborough fossil fuel project, which is expected to have a 13.5% rate of return and a payback period of roughly around 6 years.
And for BHP shareholders, the divestment of coal and petroleum should allow the company to reduce its capex significantly. The petroleum division, for example, takes up about 40% of the total capex spend for BHP. So it will strengthen the balance sheet and allow the company to reinvest proceeds to keep its mines productive especially in growth initiatives across copper and nickel, and keep its debt under control and possibly pay out higher dividends.
So the completion of the merger is targeted for the 1st of June 2022, although it remains subject to approval by Woodside shareholders, which is anticipated by the 19th of May 2022. And on the record date, the 26th of May 2022, BHP shareholders are expected to receive one Woodside share for every 5.5 roughly BHP shares they own. So the shares will be allocated on the 1st of June. This allocation will be treated as an in-specie dividend, which will be fully franked. So for those that can get utility out of franking credits, this deal is obviously of interest.
Now, importantly, for many of you at home that own less than 1,000 shares of BHP, there will also be a share sale facility available to you where you can elect to receive the proceeds in cash instead of being allocated the Woodside stock. So in effect, the Woodside shares allocated to you will go into this share sale facility and will be auctioned off to the market. And the sale will be free of any brokerage costs or stamp duty. So any of you interested in the fund approach here is that we do own a position in both our growth and income portfolios, and we view the deal quite favourably, particularly for our income fund, where our franking balance will be boosted before the end of the financial year.
Yeah, so hopefully that helps a lot of investors who are holders of these two stocks. But again, thanks, Matt, for your insights today.
Thanks again for having me, Kien.
Also, don't forget to tune in on our Lincoln Live this Tuesday, where Tim, myself, Matt, and Robbie will be there to help answer your questions on stocks, portfolio strategy, and also using Stock Doctor. So to summarize for today, the trend in the US and Australian corporate earnings remains quite strong. So high quality companies have been able to maintain the guidance despite inflationary cost pressures. Take advantage of the share price volatility if you are not sensitive to volatility across those stock opportunities. And those ones we've mentioned, for example, today include Netwealth, Brambles, or even Woodside Petroleum. Take care and have a happy, healthy, and prosperous week, everyone.